Okay, let's dive into this explainer. We're looking at how Singapore quietly engineered itself into the absolute premier hub for cross-border wealth management. You know, the global financial landscape is shifting incredibly fast, and Singapore didn't just stumble into becoming the epicenter of private wealth. They intentionally built these highly specialized, aggressively efficient legal structures to attract it. So here's the big question we're unpacking today. How exactly do the world's ultra-wealthy structure and actually protect their assets in Singapore? Because when families hit a certain level of ultra-wealth, they aren't just dropping their money into a standard bank account or a generic holding company. No way. They are building fully customized, multi-generational architectures to architect the ultimate wealth preservation machine. To answer that, we've got a quick roadmap for today. First, the Singapore wealth ecosystem. Second, the VCC investment vehicle. Third, the SFO family engine. Fourth, matching that vehicle with the engine. And finally, number 5, unlocking those incredible tax exemptions. All right, part 1, the VCC, or the investment vehicle. Let's start by looking at the actual vault where the assets are held. Now, you've probably heard this acronym thrown around in financial circles, but what exactly is a variable capital company, or a VCC? It sounds super complex, right? But honestly, its foundational purpose is surprisingly straightforward when you look at what it was designed to replace. Here's the crucial thing. A VCC is not your normal everyday business. It's a highly flexible, totally specialized corporate structure designed specifically for investment funds. Unlike a conventional company where your capital is really rigid, a VCC offers incredible flexibility for things like capital, dividends, and redemption mechanics. It makes the whole process fluid, which is exactly what you need for holding investments. If we look at its absolutely simplest form, the independent fund, you've got one standalone VCC pulling everything into a single bucket. You've got your professional fund manager, the VCC itself, and it just invests directly into underlying portfolio companies. It's totally clean, it's direct, and it keeps everything perfectly consolidated. But honestly, the real magic happens when you look at the alternative umbrella structure. In this setup, a single VCC houses multiple, entirely ring-fenced subfunds. Each subfund can have entirely distinct portfolio allocations. Think of it like a giant apartment building. It's one overarching corporate structure, but there are entirely separate independent units inside. By law, the assets and liabilities of one subfund are strictly segregated from the others. Of course, to actually get the benefits of Singapore's tax network, you've got to play by their rules. And the key test here? To maintain Singapore tax residency, the vehicle's strategic control and management must actually be exercised in Singapore. It's not enough to just incorporate there. If your board of directors is making all their big strategic policy decisions sitting in London or Hong Kong, simply having a Singapore VCC on paper absolutely will not cut it. Moving right along to part 2, the SFO, or the family engine. We've got the vehicle built, so let's introduce the brains of the operation. A single family office, or SFO, is basically your dedicated management team. It's an integrated platform for private wealth across generations, owned and operated for just one founding family. It doesn't raise money from the public at all. Its sole mandate is long-term wealth stewardship, investment oversight, and generational governance for that specific family. This setup creates a really brilliant separation of powers. The family puts their capital into the fund vehicle, where the wealth sits. Completely separately, the family owns the SFO management company, which employs the actual professionals to make the investment decisions. So the engine directs the vehicle, but the management liability is kept beautifully isolated from the assets themselves. It's a perfect firewall. Which brings us to part 3, matching the vehicle with the engine. Let's see how these two pieces snap together into a really synergistic ecosystem. If you look at a standard private limited company versus a VCC, it's pretty obvious why the ultra-wealthy go with the VCC for investments. A private limited company is a great general-purpose vehicle with a fixed share capital structure, perfect for running a regular family business. But a VCC is specifically designed for funds. Its variable capital means much easier issuance and redemption of shares, matching the fluid nature of deploying investment capital. And pitting the SFO and the VCC side by side really clarifies the whole architecture. The VCC is the vault, the investment vehicle that actually holds the family's assets. Meanwhile, the SFO is the management organization, the engine pulling the levers and directing that wealth. The VCC is the what, and the SFO is the who. You absolutely need both working together to make the machine run. Okay, part 4, unlocking tax exemptions. We've built this amazing machine, So how do we fuel it with Singapore's premier tax incentives? Just for some quick context here, any standard corporate income in Singapore that isn't covered by an exemption gets hit with a prevailing baseline tax rate of 17%. Now, 17% is highly competitive globally, but when you're compounding hundreds of millions of dollars over generations, that is a massive anchor on your growth. But here is the real game changer. Under Sections 13O and 13U, approved family funds can actually achieve a total literally 100% tax exemption on specified income. Imagine generating dividends, interest, capital gains, and trading profits on a massive global portfolio, and paying absolutely zero tax on it in Singapore. Now, to unlock this, you do have to commit to the local economy, and the rules depend on your fund size. For a 13O onshore fund, you need a minimum of 2 investment professionals, and one has to be a non-family member, plus a minimum of 200,000 Singapore dollars in local business spending. Step up to the 13U enhanced tier, and you need a minimum of 3 professionals and tiered spending that starts at $500,000. It's a trade-off, right? A commitment to the local ecosystem in exchange for that 100% tax break. If you manage to hit those requirements, that 100% exemption applies to a really massive list of designated investments categories. We're talking cash and financing instruments, foreign assets, commodities, environmental assets, structured and alternative investments, and even special foreign structures. It gives the SFO incredible latitude to build a highly diversified, totally global, and tax-free portfolio. There is one super important caveat to remember here, though. If you're using an umbrella VCC, while it is legally considered one single entity, tax computations and losses are strictly ring-fenced at the sub-fund level. So, if your real estate subfund takes a huge loss, but your tech startup subfund triples in value, you cannot offset the loss against the profit. The ring fencing protects your assets, for sure, but it also tightly segments your tax reality. Seeing how seamlessly this VCC vault and the SFO engine work together really makes you think. The ultra-wealthy aren't just out there picking stocks. They're literally engineering environments where capital is completely shielded and growth is entirely untaxed. It leaves us with a pretty provocative question to end on. Is your own long-term wealth strategy built like a simple bank account, or is it time to start thinking like a family office? Is your wealth architecture truly built for the future?